I want to get big picture right off the bat. When you look at commercial real estate in America today, what do you see?
Well, look, I guess I would start out at a high level and say, generally speaking, and I say the word generally because real estate is such a large and diversified asset class that every general statement you make has an exception. But generally speaking, we think the markets peaked in 2016, likely in the first half of 2016, in terms of pricing. We think that the markets have now transitioned into a period of what we refer to as pricing discovery, which is usually the onset or the precursor to the next correction.
What do you mean by pricing discovery?
Largely that a big bid-ask has developed in the marketplace where buyers and sellers are not connecting on transactions. And you see it most profoundly in transaction volumes. Transaction volumes in 2017 are way off 2016 levels, plus or minus.
Across commercial?
Across commercial real estate, across geographies, plus or minus 30% down. And in particular, you've seen a real fall off in foreign transaction activity by foreign buyers, and that is very important to watch because foreign buyers were such a large driver of both pricing and volume in this last recovery.
Well, we hear that there's a lot of dry powder. We know that pension funds are allocating more of their assets to real investments, like real estate, for example. And we know that sovereign wealth funds continue to deploy more money out of public markets into private markets. So is this lull, if you will, this drop-off in foreign transactions temporary?
We think like anything else, it goes in cycles, and in particular over the last 2 years, foreign buyers have been incredibly active in the U.S. real estate markets, largely in the primary markets. And so we think they are taking a little bit of a deep breath. They're both absorbing what they have bought, but at the same time, they're looking at that next tick in terms of where pricing is going.
So cap rates are low across the spectrum. Prices, as a result, are high, right, relative to cash flow. If we look at multifamily, if we look at office, if we look at hospitality, if we look at retail, where are valuations most stretched?
You know, I guess I might not look at it necessarily by asset class. I'd probably look at it a little bit more by geography.
Okay.
Very interesting in this last cycle, when you mention all of those individual types of investors, they have been very focused on deploying more money into real estate as interest rates have remained artificially low, but they have been very focused largely on the major markets, the top 6 to 10 markets across the country. So when you look at cap rates, when you look at those major markets are up 40% over the prior peak level. If you look at it from trough levels, they're up 120%. You've never seen in prior cycles this type of both cap rate compression and value appreciation. And our feeling is that as QE unwinds and as interest rates rise, we saw that yesterday, over time, cap rates will normalize, and the markets that will be most affected are those primary markets.
So the ones where, when you say cap rates will normalize, when we look at office, when we look at multifamily, they're in the 5.5% to 6% neighborhood. They'll reset to what?
Well, I would love to say if they were in the 5.5% area, we'd probably be much more active in buying a lot of those. But we've seen cap rates drop. If you take New York or some of the West Coast markets, on the multifamily side, you've seen cap rates dip below 4. On the office side, you've seen them dip below 5. Those are plus or minus 200 basis points inside of historical levels. Now, we're not necessarily saying they're going all the way back to historical levels because there's much more permanent capital allocated to real estate today. But we do think over time, as interest rates normalize, cap rates have to continue to move back.
Which markets are most vulnerable?
We think it's those primary markets. It's the coastal markets. It's the larger Midwest markets like Chicago that has really experienced most of the cap rate compression and, interestingly, most of the foreign activity over this past cycle.
And again, cap rates are a function of price and cash flow. But if we are talking strictly in terms of price, things are going to reset by what?
You know, obviously, I don't know we have a perfect crystal ball to say where they're going to go. We would say in today's market, and this is just purely anecdotal, if you look at auctions and the bidding process and how many people are showing up and how long due diligence takes, we would say that bid-ask gap today is probably 10%. That if buyers were willing to pay 10% more, sellers are willing to take 10% less, you would see much more transaction volume. Where it goes from here will be much more dependent on what comes out of D.C. and how effective those policies are.
What is different, Steve, about the way that you and OXIF invest in real estate relative to, say, Blackstone, a firm where you once worked, or a Starwood, or a Colony North Star, big real estate investors people are generally familiar with?
Well, look, in a similar vein, we all raise commingled funds. We all invest across the credit and equity spectrum across multiple product types. What I believe really makes us different is how we have integrated the real estate group into everything else that OXIF does as a firm. Public markets activities, credit, private equity, energy.
But do you have, I guess what I'm trying to get at is, do you have more of an appetite for risk than they do?
We don't think it's risk. We think by casting a wider net, so we've invested in over 100 transactions, 19 different real estate related asset classes, everything from the 4 major food groups, hotels, but also things like cell towers, gaming, hospitals, senior housing. We think ski resorts, convenience and gas stations. We think by having a larger funnel at the top, but keeping that spigot at the bottom very tight, we can find the best risk-adjusted deals in the marketplace, plus really deliver a diversified portfolio, because it's our belief buying retail and office and hotels in the major markets is going to be very correlated.
Given your view, your outlook, how comfortable are you committing capital today? And do you still think, as you look out, you'll be able to generate the sort of mid-20% returns that you're looking for?
Look, it's a difficult market. It's a market to be patient and much more disciplined. What we look for today in transactions, and in fact 2016 and early part of 2017 was surprisingly one of our most active years in deploying capital. But what we looked for and found were areas that were devoid of capital, where we saw a motivated seller but stable underlying fundamentals. So you mentioned ski resorts. One of the recent transactions we did, we bought 14 leased ski resorts from CNL, a large private REIT that was going through a liquidation process. In that transaction, we actually really liked the underlying fundamentals of the business. We found a motivated seller that was looking to liquidate its entire portfolio, and ski resorts is an area that just doesn't attract as much capital as many of the traditional markets.